Hi everyone, and welcome to the next episode of the HeelanHub Podcast, the show for small business owners. I'm Dan Heelan. On today's show, it is me talking to you today about how to pay yourself from your limited company. Now, if you're a sole trader or a partnership, there might not be that much in this one for you, but hopefully if you're thinking in the future, I might want to be, then hang around because I think there's some cool tips in here. And as the tax year has changed, as we're recording this, it's May 2025. So we've already had a month of the tax year, but despair not. If you've got this wrong already, you can absolutely adjust as the year goes on. You could even, if you've done an annual payroll, you could potentially refresh that. It's all possible. So yeah, don't worry if after listening to this, you think, do you know what? I might have made some mistakes here. It's all correctable. So let's get on with it. So then I think with limited companies, a lot of the tax saving around how you pay yourself comes from various different taxes. It's not as simple as it's just one tax. Normally it's a combination of corporation tax, that's the company's tax. Then you've got your personal tax. You've got your personal national insurance. And on top of that, you've got the company's national insurance that it pays on your wages if you pay over a certain level. So quick recap on the changes. In the 25-26 tax year, the one we're in now, there's been some really bad changes about employers' national insurance. So how it used to work is anywhere over 9,100, anytime you paid over 9,100 to anybody, you started to pay employers' national insurance. And that would be at a rate of 13.8%. And that was pretty pricey back then. And it's even worse now. That 9,100 limit's been reduced to a mere £5,000. And then on top of that, the rates increased to 15%. Now, we've done loads of other podcasts on talking about the impact of that. I think there's one we called it April Changes or the April Pain. I think there's another one we've just recorded talking about employment allowance, which we're absolutely going to touch on in this video, I'm sure. And the combination of those things is all relevant for the 25-26 tax year. But I think the short of it is for most employers, if you've got a team, it's going to be an expensive year. But we're talking particularly in this episode about how you pay yourself from the limited company. So it's going to be in and around that. And of course, with all these videos and podcasts, we're always presuming that you're a UK small business owner. It's a UK limited company and that you're the owner and the shareholder. It's like your main deal and you're going to be here doing it. I'm not talking about if you're in like a massive company, then the chances are you're just going to be on payroll like everybody else and there's nothing you can do about it. So this is really for that small business owner where it's your business. So let's kind of think about it. And I think just recap on the best way to pay yourself. Now, I'm going to do the massive accountancy caveat right at the beginning of this and say the true answer to this is it depends. And when we say it depends, it's because there's loads of things in play. There's what's your goals? What's your business goals? What's your personal goals? Is there a mortgage in play? Is there research and development tax credits in play? Have you got other income? Do you need a state pension? Like there's a ton of them. I could list loads of them. Is your income going to be over, say, £250,000? There's a lot of different options that could be in to determine what is actually mathematically the best. And sometimes even mathematically the best is not going to be what you'll do because you'll want to make it easy for a mortgage lender or you want to do certain other things. So just bear that in mind. And if you're an accountant listening to this, because I know there's a load of you, I know you will know this already, but it's worth us saying this at the beginning, as I'm sure you do to all your clients. So with that disclaimer out the way, of course, go and get yourself some advice about your situation. But if you're doing this yourself and you're trying to navigate it for various reasons, I think it's worth us just talking about it. And not necessarily even if you're navigating it. If you're working with an accountant, you just want to understand why this small salary, why am I getting no salary, these kind of things. This is going to be the podcast for you. So let's look into it. In terms of actually paying yourself then tax efficiently, there's normally going to be a small director's salary. And then on top of that, you're just going to take the rest of the money out in profits, in dividends. And that's very normal tax planning. And at certain levels, as I said to you, like let's say you took out £250,000, you might find that actually it's cheaper to go payroll, but it really does depend. But let's just presume for the majority of small business owners, this is absolutely going to be the strategy. And it's been the strategy for many years. It's just that the governments have progressively whittled away at the savings. If we go back maybe a decade, that makes me feel really old now thinking about that. It only feels like the other day, but say like 2014 and before, there was really good, pretty low tax rates. So there was a dividend allowance you could take out even before dividend allowance, the rates were cheap. And then the rates have got more expensive on dividends. The allowance of tax-free dividends has come down to a mere £500. And at the time of recording this podcast, they're talking about potentially getting rid of that completely. Although I don't think we should go as low as zero. I think there should always be a small amount of dividends you should be allowed tax-free because otherwise everybody ends up needing some sort of tax return or being dealt with because of the tax bill on the extra. If you just randomly retail, as a retail investor as they call it, and you ended up buying some shares in Tesla because you fancied it, and then it returned you a dividend or whatever the company would be, you could end up having to do some sort of tax return. So I think there's a limit to what they would want to do without making it all taxable. But anyway, this is under threat at the moment we're talking, but just goes to show you where they're thinking of drawing in more tax, means that actually it's still efficient to do it this way, and there is a good motivator to go from, say, sole trade or partnership into limited company for tax saving, bearing these things in mind. But it's a lot closer than it used to be. I think we see a lot of them now where you could take it or leave it. Limited company is still vastly dominates, I think, anybody that's trying to grow a bigger business for more reasons than just tax. But, going back, say, even probably less than a decade ago, it was very easy to show somebody at very modest income levels why, for tax reasons, it was better. Now we can show you for sure that you'll save tax, but then you've got to offset that against maybe additional accountancy costs or more hassle in compliance. So those things all still exist. But if we just presume generally there's still tax savings in doing this, then that's what's going to happen is you're going to pay a low salary and a high dividend. Now, that's not always going to be the case. If you're listening to this and you've got a full-time job and you're on a side hustle, for example, and this company that you've got is a side hustle, it might be unlikely that you're going to declare yourself any salary because you've already using up your personal allowances in your other job, and it starts to get complicated and not mathematically very good with your tax. So if that's you, you're likely probably just to go all dividend, but not always, as we've already said. You might not be earning enough in your other job, or that you might still want some salary in the company. And again, those things are hard to describe on a podcast, but there are scenarios. For example, let's say you've got a very part-time job and you're only earning £5,000 in your part-time job. You might well want to maintain your state pension record, and we'll talk about that in a sec, and therefore paying yourself a salary of over £6,500 from your limited company is going to be really beneficial for you and maximise some more tax savings. So there are lots of factors, but let's do the main scenarios that you can just see. So I think with the general concepts out the way, in terms of the fact that we know that we want to be paying a salary where this is our main deal, there's no other income. Let's just presume that scenario, nice and easy. That's what you're going to do. Then the best with Little Bunny is salary you're going to pick for the 25-26 year is likely to be one of two options. You're either going to go 6,500, and I would say go over that to really make sure. So you might want to do something like 516 quid, I think, just thinking of the rounding, so that you can really make sure that you go over it. And the reason that level is good is because, one, you get a state pension qualifying year. So the way the state pension works is you have to have an amount of qualifying years, well over 30, to make sure that you get your full state pension benefits. And it used to work that you could pay yourself a limit that meant you didn't pay any national insurance at all, but you got full state credit. This has now changed. With this limit coming down to £5,000, you've got to pay some national insurance to get that benefit. And I think there's an argument there that could be fair, but anyway, that wasn't the case. But anyway, it is now. And now that limit is £6,500. So you want to be over £6,500 in a year. And the reason I wouldn't do it, and I'm a big fan of this anyway, I don't like doing things to the exact pence because it's so easy on rounding to make a mistake. And we see this with people's state pension records because you can check yours. You can use your personal tax account to log in and look at it. And we see so often that somebody's missing a year and they're like, no, there's no way. And then you realise that due to rounding, they were £4 under or something on the amount of salary they needed in one job. So it's from one job, you need more than £6,500 to get it. So I wouldn't muck around with the rounding. If you divide it down per month, I'd just make sure you were clearly over it, because you add an extra tenner a month or something and paying a tiny bit more national insurance is not going to ruin the bank, but it is absolutely going to ruin your state pension record if you get it the other way around. Now, you quite often would use that limit if that in that example I said a minute ago, where you've got maybe a small side hustle, but it's not enough to pay for and get enough in one job in small pension credit. So, and you can have weird ones as well, where you might have one job at £4,000 and another one at £4,000, and neither's over 6.5. So you're not really getting any qualifying year in either. So, and then you would stack this £6,500 on top of it. Now, that would mean it's probably not mathematically in a tax sense the most efficient, because if you added, say, £4,000, £6,000, then you're going to be over the £12,570 that you're allowed to earn as an individual tax-free during the 25-26 tax year. So, and you really, the best alternate salary is going to be paying at that level. Now, I'll go into that in a minute, but let's just keep on this one for a moment. If you think about it, you're going to start to pay some personal tax at that level at 20%, and you will pay some national insurance, and you don't really want to. But if getting your state pension was really important for you, you're going to pay that little bit of extra tax and get that state pension qualifying year. So it's these kind of things that always get considered when you're looking at it. But for that reason, quite often the 6.5K gets paid. You might also have things like rental income and other things that don't really contribute towards that pension state qualifying year. So if you're interested, go have a Google. I can't really cover all of the scenarios in this podcast, but you go and have a look if you've got things that don't necessarily qualify, or maybe you've got just dividend income that comes in and the dividends are 15 grand. That'd be amazing. But I have seen plenty of times where people have got large dividend portfolios, but maybe they're not getting enough income on paper to get that pension year and they still need it. Then even though it might not be tax efficient, it is salary efficient, and having some there is worth doing. So that's this weird, less common type that you would often pay at this 6.5K level. But really the takeaway from this is if you're going to do it, make sure that you pay over the 6.5K. Now, the most common salary level by far is going to be £12,570, and that's because it's your personal allowance. So as we just said, there'd be no personal tax on that. But what you are doing is you're paying no personal tax. You're paying a bit of national insurance from the company. You personally, you're not going to pay any because of the way it's set, but the company's going to pay some, as you've already explained, at 15%. The bit between £5,000 and £12,000 and a bit that we're going to be paying is going to be payable at 15%. Now, there might be a way to offset that with employment allowance that we'll talk about in a minute. But if not, you're going to be paying about £1,100 in national insurance. So it's not small. But the reason you do this and then trigger these bills is because your company can get a corporation tax deduction on your salary. The actual salaried amount comes off your profits, reduces your corporation tax by a few £1,000s. So it's worth doing. And that reduction is somewhere between 19 and 25%, depending on where you're paying your corporation tax. So it's worth doing. And again, I could show you the maths, but it's absolutely worth it. And what I would say is on our main YouTube channel at Heelan Associates, we've done a video on this, on directors pay and yourself for a director. I can't remember the exact name now, but if you look for published date, probably in April or May 25, you'll find it. And I actually do bring up a spreadsheet and show you so you can see this in a bit more detail, but it's always hard to do on a podcast. So you just have to trust my maths that this is what people do. And there's plenty of information on the internet that will tell you why. But ultimately, that's the most common salary level, is going to be at this personal allowance level. And then you're going to top up in dividends. But the reason it works, which I think is the biggest thing to understand, is that it maximizes the amount you can put through without paying any personal tax. So, and the more salary, the better to reduce the company's tax bill. But it starts to go out of kilter when you start paying yourself too much salary. So I think the example I give in the video is paying yourself, say, 25 grand. You end up paying a load more company, employers, national insurance, and that ruins it. So not only are you paying more personal tax at 20%, you're also paying employers' national insurance, and you're not getting enough of a tax deduction in the company to outweigh it. So it's the balance of those three sort of taxes that really makes the difference. So bear that in mind as you do it. And we did talk on about employment allowance. So the reason I touch on that, and if you go back an episode, I believe on the podcast, I talk about this £10,500 as an employer you might be missing out on. And it will tell you a bit more detail about how you might be able to use employment allowance to cover off that employer's national insurance bill we spoke about. The challenge being, though, if you're a sole director with no other employees, you're just not going to be eligible to claim it. You actually have to have somebody else on a bit of a decent wage to claim it. But rather than step on the toes of the episode, I think you should just go back and listen. It's not a long listen, and it will cover it off very shortly for you, regardless of whether you've got any previous knowledge or not. So go and have a look at that. They're the two primary rates that are there. And as I say, the 6.5K-ish figure is not an exact science. It's just it's over what they call the lower earnings threshold, and it's important for that national insurance state pension. So that's the reason that I do it. But do go and crunch the numbers. But in general terms, that's what you're going to do. So, and as a reminder for you, if you're going to go and declare yourself salary, you need to have a payroll, a proper payroll. You can't just pay yourself the figure and say that's my wages up to the salary. The way it works is you need to make yourself an employer with the revenue. They'll send you a PAYE reference. You have to submit real-time returns through payroll software. There is currently a HMRC basic tools. I always think, and I joke about this, if you're a long-term listener, you'll know this, that it should be under trade descriptions, because I don't think it is very basic, but it does allow you the feature to be able to go and submit a very simple payroll. I'd rather you use something like Xero's payroll add-on or something like that. It's an easy one, particularly if you're a single director, to go and do. They do have a way of doing it through for free. But if you do think about a Xero and you're interested in picking up a license, we actually have a code. You can go to heelanassociates.co.uk/Xero. If you're a new user, there's a great discount there. So go and pick yourself up a license. But and you can easily do the payroll through there. So, but you would need to submit those real-time reports. And you've got, I don't want to, again, go too deep into it in this episode, but there's lots of ways you could submit that salary. I'm a big fan of monthly, and actually for us as a business that, sells a payroll service, it actually is commercially better for us to probably do them annually. But I much prefer doing it properly in line monthly and having the flexibility to bend and change that. If we've got some other income later in the year or something changes, it's easy enough to just stop a salary or top it up later if you need to. So for some clients, what they might do if they think they've got some other income is they might set it at the 6.5K level and do that for a few months and then decide whether they're going to carry on. And then you can always top it up later or top up 1 month and close the payroll or whatever you want to do. Just personally, I find doing it monthly and reacting is a better way. But there are plenty of people that just do one on an annual basis and just declare it all. But you do have to be careful about when you do it. And there's lots of other reasons. But do it monthly, I think, is the easiest way, albeit it's the slightly more time-consuming way. But for me, it gives the maximum kind of flexibility as we go. Now, there's definitely debate about that. Now, that's where we are with it. And as I said to you, I think you've got to really consider all of the other sort of things about mortgage goals, what you want to do, what you want to show people and things like that as to whether the salary is the best. But that's where we are. Now, the other thing you might consider, and I think when we're talking about paying yourself, is we're just talking about salary at the moment, haven't we? We've talked about this idea that salary plus dividends is going to be great for you. But there are other things to consider. So, for example, if you put a lot of money in at the beginning and you open what's known as a director's loan account, then you might think, okay, I'm just going to take some money back instead of declaring my salary. Because if you put it in from tax money. When you bring it out, it's also tax free. So that's a really good way of doing it. And actually, sometimes if you've got a large director's loan account, you might consider charging the company interest because there's a separate savings allowance that makes a lot of that interest that comes back free. But there are some real practical problems with doing that people get fed up with. So quite often people may discount that purely over the fact it will save tax, but it's a right pain. But that one is there. It's a bit actually out of date, those rules. I think the revenue, like many things, need to update how this works. But if you start paying interest from your company, you've got to do returns and you've got to hand over basic rate tax. It's just messy. So, but that is there. So there's that possibility. But I suppose a point to be careful of is if you have got a large director's loan and you're just going to take all the money back by director's loan, make sure you are considering that state pension point we talk about. Or if you've got no other income, you're probably still going to want to declare a salary, at least for that first 12.5 grand, overdrawing it from your director's loan account. Your director's loan account also doesn't count as personal income. So then you have also a problem with if you're trying to prove earnings for mortgage, you haven't paid any taxable income, you haven't got any earnings as far as they're concerned. So you really have to balance that one, but that is possible. I think the most times we see that is someone will quite often pay, say, a 12.5 grand-ish salary, and then they'll top themselves up with dividends up to around 50K, because that's where the higher rates of tax kick in. You sort of stack it like a load of books, and then anything over that starts to be taxed at those higher rates. And then they might start to use that director's loan account to draw off any additional funds if they're cool with only being able to prove 50 grand's worth of income. So, and I think for a lot of people, that's what they do. They might also consider if they've got significant others that can come and work for the company and get paid, use their bands. There's a lot that goes on with multiple people. That's very common. So stereotypical husband and wife, for example. So let's say it's the wife's business. She's a HR consultant or marketing expert, and she's doing that small salary, top the rest up to about 50K. But actually, there's profits in there. We want some more money, and maybe the husband's only got a part-time job because of childcare or because of anything else. And then we might look to bring him in. Maybe he wants to give a bit of admin or bookkeeping support to the business, get paid for that, use some salary there, or be paid some dividends if we arrange a shareholding. There's lots of different ways to do that, and that's probably another podcast. But splitting income efficiently needs to be done properly so you don't fall foul of any rules, but can be really, really efficient. And that's where, when I was talking to you about the difference between, say, sole trade taxation and limited company taxation being a lot closer, when you start to bring in multiple people, it really starts to sort of diverge again on what's possible at those income levels. So if you're in that sort of 50 to 100 level, the savings can be massive if you get this right. So if you're thinking you're going to earn that, and that happens a lot in, say, consultancy businesses, things like that, then it really does start to get big. Anyway, I tangent. So you've got those options. You've also got things like thinking about, you could potentially, depending what you do at home and your situation, rent or lease a room to your business for like non-exclusive use of that room. That one's a bit complex, but it's possible. Again, comes with a lot of hassle that might not be worth it. But in certain situations, if you're looking for the most with money is tax efficient way to do it, you'd have to consider things like rent and interest and things like that, but it's potentially possible. And of course, the biggest, most obvious one really from a tax planning point is whether you want to contribute to a pension, because the limited company brings with it this awesome possibility of paying yourself, your company making contributions direct to your pension pot, which become tax deductible in most circumstances. And that's awesome. And that makes sense if you think about it. If you were bringing a team on and you had to pay pensions to them, you had to contribute to their pension, then of course you would want a company tax deduction. And actually it applies to you yourself as the director as well. So even if it's only you, this one. So there is a really good way of paying into the pension. And that's just like 3-4 ideas in there to think about. There's a few more, certainly a few more, but these are the most obvious ones I'd get you to think about. Now, the pension planning one doesn't have to be done at the start of the tax year. You could decide to do it later. You just got to be careful on when, because in order to get a tax deduction in the company, it's based on when you physically pay it, which, without getting too complicated, for many accountancy rules, dates are more important sometimes than payment dates. With the pension, it's actually important about when you pay it. So weigh up the fact that you need to make a payment in a tax year to make sure that you're utilising your individual limits of how much you can contribute. If you're going to bounce off those, they're quite high. But if you were making big contributions, it's worth knowing. But you're also balancing it alongside what's my company's year end, what's the next tax bill I want to reduce. You're not going to lose the tax deduction, but it might end up in the next tax year and you end up paying a big tax bill that could have been reduced. So common. So bear that in mind. So paying into a pension is a massive one. But I would say, just to really jump on that point, we're not talking about you drawing money to put personally into your personal pension and get a tax top up to the pot. We're talking about the company making a natural contribution straight in as an employer's contribution. Means your tax pot doesn't get a top up of any tax, but it's got the money out of there tax free, but the company's got a big deduction on it. It can really affect your corporation tax bill in a really positive way. So, I mean, I've seen some crazy good ones this year where people have just created this pot of money, felt safe they don't want to be touching the money till they're, over 55 and done their sort of due diligence about where they want to invest it. And then they've made those contributions and the company's benefited and massively reduced the tax bill. So it's a really key one to do and something that is often overlooked. So I think I also like examples where you have, let's say you're mature in your career, you've started a side hustle up, you've booted a limited company up, generating some money there. Maybe you're doing some consultancy on the side, very 2020 plus, I guess. What do you do with it? If you draw it and you're earning decent money in your job, you're going to pay income tax, potentially national insurance, or you pay dividend tax and then you've got to deal with that. Or you could think, well, I don't need it. I'm going to put it in my pension, reduces the company tax bill, potentially wipes it out and moves it across into your pension. So it can be really, really good. So there's that. There's other things you can do later on that's probably outside the scope of this podcast, where maybe you want to think about property investment. How could a company own it? There's other things. But I don't want to go too deep into that one because that's an entire podcast on itself for sure, where we debunk some myths about TikTok tax advice. So I see a lot of tax advice on TikTok at the moment, which really misses some really, really key points about property ownership in limited companies. So I don't want to go too deep on that one, but let's just say you really need to weigh that up with where the world's going with that. So that's it. So, final one on this. I should say that if you've been used to this idea that you pay yourself some wages and it's cool every month and all you were listening to this for was, just making sure you're on the right path and what's the new figure that I need to be paying on my payroll. Bear in mind, because of the changes, one of the big practical changes is that this year, where you might not have before, you're actually going to have to physically remember to hand over and pay your national insurance that's going to be due to the revenue every month from the company. Now, there's 2 ways of setting that up, a little bit complicated, but one of them is pay every month, and some people will find that easier. And there's another one where the actual kind of calculation and the prompts to pay as a director won't happen until later in the tax year, probably like December onwards. And a lot of people will like that one because of the flexibility and the fact you'd have to remember it for most of the tax year. Weigh it up. There's a tick box in your software, basically. If you're working with an accountant, they probably got their own or payroll provider, or bookkeeper, they probably got their own preference. So just chat to them about how that might work, but just keep an eye out for it because it's something new this year that many of you might not have seen. If you've been in business a while, you may have remembered a time where you did pay these. I think in recent years, where not much has moved, it hasn't been the case. So there we go. So as we said, you're going to pay those limits, and you could be saving quite a few £1,000s worth of corporation tax in the scenario, balanced with the national insurance that you're paying. So do that. Do check out the previous episode on employment allowance, because if, for example, in the husband and wife scenario we spoke about, there might really be a good opportunity to claim employment allowance, which is going to save you a load more tax as well. So that's going to be a really good one. So if you have enjoyed today's show and you got value from it, you can watch me literally talk at the laptop and at the camera on these shows on a side YouTube channel we've created at the Heelan Hub, and have a look on there. And as always, if you're looking for more in-depth of me talking over spreadsheets and everything else that can't be done while you're out walking the dog, going for a run, gym, wherever you're listening to this to, make sure to visit our main YouTube channel at HeelanHub, where there is full detailed guides of this kind of stuff. If you've enjoyed the show, please do subscribe via your favourite app. It really helps with the visibility if you can drop us a review as well if you get 2 moments. I know most of you find us through Spotify, but you do come from all over the place, so thanks very much for your support. For more business insight and tax tips, honestly, the best way to do that and keep up with it all is to sign up to our newsletter direct to your inbox every 2 weeks. And that's just go to heelanassociates.co.uk at the minute. Just scroll up and down for like 5 seconds and you'll get a prompt. We're changing that, but that's currently the way you would do it. And follow us on all the social media channels, including TikTok now. We're pretty cool. We're on TikTok, LinkedIn, Instagram, of course, LinkedIn, Twitter, and pretty much anywhere, Facebook, anywhere that there's a social media channel will be on there. And that's the way to get us. But YouTube is by far the best instructional way if you want to get good guides on there. As I mentioned earlier, if you do want to move into the world of maybe doing your own payroll on Xero or just getting yourself some accounting software in general, Xero is the way forward. HeelanAssociates.co.uk/Xero for a discount code there to go and get yourself some Xero. As you'd imagine, we get a little bit of a kickback, help support. So thanks very much for that. And if you want to get in touch about the podcast, you can either ask some questions via the YouTube channel and we'll do our best to give you some generic advice, or if you want some direct one-to-one support or anything like that, you can get in touch with us in the usual channels, but info@heelanassociates.co.uk will put you in touch with our team. That's it. Have a profitable and tax efficient couple of weeks, and I'll see you in the next one.